Amanda and Matt so much for joining us today and making the time. I know you guys are busy running a big firm, and so really, really appreciate you spending time with us. We are a brokerage of agents who are looking to really become experts in our field and really hone our craft and give real value to our clients. And so we do this roundtable every month to talk about laws that are changing, any practices within, real estate that are changing that we need to inform our agents of. And this market for us has been really challenging. It's been really shifty. And so we've been working really hard to try to provide value for agents. But one of the things that keeps coming up is strategy. Home sales are at a multi-decade low. I think we're on track to do like 4 or so million transactions nationwide. Where at one point we're at 7 million plus. So this market has been challenging. We've been pretty lucky here in Northern OC to see some good activity. Um, but still we're kind of in a challenging market. And so the word that keeps coming up as we talk to clients and trying to figure out ways to help them with their real estate is strategy. And what can the strategy be, especially if someone's locked into a 3% interest rate? There's got to be a profitable strategy to convince or to compel someone to sell that and move, right? And so we do things like travel to other states, other markets that Californians are migrating to see what's out there, to get a hold of agents out there that we really trust and have a relationship with that we can refer clients to. Uh, and so one of the big things again is strategy. And in that strategy conversation, it's a big scary word to most of us, but it's tax. So thank you guys for joining us today as tax experts. So I did find you on Instagram at all places. You have a great following and tons of great content. And so yeah, compelled me to just reach out and see if you're available, and come to find out you guys are neighbors. So um,
Yes.
really cool, really glad. And I don't doubt that after this webinar, there'll be plenty of people reaching out to you and trying to bend your ear on some strategy and tax. Um, so yeah, with that, if you could maybe let us know who you are, about your firm, your practice, and yeah, if you could let us know who you are.
Sounds good. Well, yeah, thank you for having us. I'm Matt McFarland.
I'm Amanda Han.
Our firm is Keystone CPA. We are located in Fullerton, California, North Orange County. But we specialize in working with real estate investors all over the country, actually, to help them do proactive tax planning to kind of, reduce their taxes, obviously. We both got our start in a Big Four accounting firm. We are married to each other, so if I start making jokes about my wife, don't get offended, please. But we met working at a Big Four firm. She worked kind of in the real estate group. I worked in a private client advisor group. A lot of private client, wealthy individuals have real estate. That's kind of where I had my aha moment of dealing with real estate investors. And then we started our own firm back in 2008. So we've had, whatever that is, 17 years now. But real estate is kind of what we do. It's what we like. We are real estate investors ourselves. Um, we don't do like there's things we don't do manufacturing retail because we don't understand it, but we understand real estate. So we like to talk to investors, realtors all over the place to help them, utilize tax strategies, to build their wealth. So I'm excited to be here and look forward to talking to you guys and helping answer your questions.
Fantastic. Thanks
And
again
we're
for being
dealing
here.
with technology at the same time.
Yeah, I'm not sure why my
It's
screen
frozen.
share is frozen.
Oh.
You guys can still hear us, right?
We could hear you and we could see the page that says about us.
Yeah, it's kind of frozen. Anyway, so yeah, super excited to be here. Matt and I wrote also two books. One is called Tax Strategies for the Savvy Real Estate Investor, and then we have an advanced version of that. So for any of you who are like, after today, you're like, I really loved everything I heard, you can check out our books from Amazon, Barnes and Nobles. Anywhere books are sold, essentially. And I promise you that it's not boring. There's not a lot of like tax jargon. It's a compilation of client stories on how people save on taxes using real estate done well, and also what happens when they don't do it correctly. So we have a lot of clients who are brokers and agents who buy our books to give it to their clients as well. So I promise you, you will not be falling asleep if you decide to read it. But yeah, so I think so. Abe sent us a kind of a list of questions and topics that are of interest to you guys. We put together a presentation, but if that doesn't work, we'll kind of get that all figured out. I think the approach that we want to talk about are two things, right? One, how do you guys in the business of real estate as realtors, how do you save on taxes? And then secondly, if you were to invest in real estate, if you were to become a real estate investor, how does that help you save on tax? And that obviously is the same concept and strategies that would apply to your clients as well, right? So we have two hats. One as a realtor, how do we save on tax? And the other hat is as investors, how do we save on taxes? So we'll kind of get started there.
Yeah, and unfortunately, I think our screen is still stuck. So I mean, I can hit escape, but I don't want to kick us out of the Zoom or whatnot. But
I think we fixed it. All right. So let's start with one big beautiful bill.
yeah, so I think one place to start is obviously there was a big one big beautiful bill was passed about a month ago now. Um, we're kind of seeing it as probably one of the biggest changes in recent history from a tax perspective. There's a lot of benefits that exist for individuals, investors, business owners, and we'll kind of get into all that stuff. Um, but yeah, it's kind of nice from our perspective because they've been talking about it for, I don't know, prior to the election, right? And so it was kind of nice to see it finally got passed because believe it or not, we've seen things in before they get passed like December 30th or something. It's like that doesn't leave a lot of time to plan if things don't get passed until the last day of the year. So with that in mind, I think there's some things that investors and business owners and real estate investors can take advantage of for sure.
Yeah, we'll start with individual taxpayers. I mean, obviously, you guys probably heard there's tax-free tips, tax-free overtime. But I think what's probably more relevant to you guys as realtors is the state and local tax limitation change. So prior to the signature of the bill, as individuals, when we own homes, right? So between primary home property tax and personal state income tax, we were only able to write off up to $10,000. For all of us in California, that's like nothing, basically. And so the One Big Beautiful Bill basically 4x'd that tax benefit. So for your clients or yourself too, right, who own homes, now we can write off up to $40,000 of primary home property tax. And when we combine that with personal state income taxes, instead of the 10,000 cap, now we can write off up to 40,000. So that's probably, pretty impactful, I think, for a lot of maybe first-time homeowners, where in the past there was not too much benefit. We can write off our mortgage interest, right? But now we just have a much higher dollar amount to write off on our primary home property taxes as well. And again, since it's based on, property tax value, very, very beneficial for people who live in high taxing states or expensive states like California.
We're going to get into this a little bit more later too, but keep in mind there is a income threshold where that $40,000 cap starts getting cut down. So at that income threshold starts at $500,000, and once you get to 600,000, that you don't lose. The deduction can never drop below 10, but the takeaway here is that very important is you'll see with a lot of these benefits, credits, whatnot, there are income phase outs. So it's going to be just as important as before, if not more, to really manage your income so that can we bring you below some of these thresholds to take full advantage of some of these benefits.
And for you guys, as well as when you're talking to clients, right? If some client is like, hey, I make over $600,000, none of these benefits apply to me, I don't get a child tax credit. Later on, we're going to show you a client example of how using rental real estate, you can really change what your taxable income is. Where, you might be someone with $600,000 of income thinking you don't get the new primary home property tax additional write-off, but when you look at the whole picture, it brings you down enough where you can actually get the tax benefit.
One more thing for individuals with respect to homes, just the takeaway is that the mortgage interest limitation, they basically kept it at that $750,000 loan limit. So prior to 2017, remember, we could deduct interest on loans up to $1 million plus another $100,000 for like a HELOC or whatnot. They took that away back in 2017, reduced the loan limit to 750. Now, if you have loans that are prior to 2017, you can still get grandfathered in. I'm not expecting that to change, so that's still good. But going forward, they did make the new loan limit basically permanent at $750,000. So something to kind of be aware of for yourselves and your clients, obviously, who are looking to buy new homes.
At a
Now we don't
small,
expect you guys to be tax people, but you know they're going to have questions about that at some point, right?
yeah, small question on that. Let's say my mortgage is 1.5 million. Did they essentially just take that 1090, is it 1098 document
Mhm.
and then just divide that by
Yes.
half?
Yeah, I mean essentially there's more to it than that, but yeah, that's basically the under perfect example. You're going to deduct 50% of the interest you pay in that example.
And one thing, just so you guys all know too, right? If you're, I mean, in the real estate business, most of our clients claim home office deductions, right? And so important to understand that 750 cap is as primary home, but if you're using your your home for home office, the office portion is not limited, right? So that's a great way to get around that limitation and really maximize the write-off on your primary home mortgage interest as well. Um, and the One Big Beautiful Bill also came out with a lot of tax benefits with respect to businesses and rental real estate. And we kind of talk about them kind of in the same context, right? Because business is you being a realtor. Rental real estate, if you own rentals, it's also a business, right? So from both contexts, a lot of the things we're talking about applies to both. The first one is under the One Big Beautiful Bill, we have the continuation of qualified business income deduction. Um, all of you should be familiar with this term, but if this is the first time you're hearing about it, you need a new CPA. Qualified business income deduction basically came out back in 2017, where up to the first 20% of your income could be tax free. So if you're a realtor and you've netted $100,000, the first 20,000 is not taxed, and you're only paying taxes on the remaining 80,000. And this is true regardless of how you file tax returns. So you could be a sole proprietor, a single member LLC, a partnership, a corporation, S corp, right? You're able to get this tax benefit. Typically, I mean, it's not, unfortunately, in the tax world, it's not an automatic thing. So your CPA does have to know how to report it. So there are often times when we review tax returns, we see that not as a write-off. So if you want to verify if you're taking advantage of it, you can pull up your personal income tax return. There's a line on the first page that's called qualified business income deduction. Make sure there's a number on there. It's, I don't know if it shows up as a negative, right? Because it's subtracting from your taxable income.
Another thing that's been kind of continued moving on with the One Big Beautiful Bill is the pass-through entity tax deduction. So for
Most
those
of you should be familiar with this. If you're not, again, you need a new
so
CPA.
this would apply for those of you who are operating as S corporations or partnerships. Basically, if you have a pass-through entity, it gives you a K1. The law, basically, for a quick summary of it, is it allows the entity to pay the state income taxes that you would have otherwise owed at the personal level on the business profit. So company makes $100,000, state of California, you owe $9,000. The company can pay that tax to the state directly instead of you paying it. The benefit to you is that the company can take an ordinary deduction for it, and that doesn't get limited. It doesn't get added to that $40,000 cap that we have on the Schedule A for itemized deductions that Amanda just talked about. So it's a great workaround. They basically are extending it with one big beautiful bill. California also came out and with their own rules saying they are going to allow continuation of the PTE as we call it. So again, if you have a pass-through entity, partnership, S corp, you definitely want to be taking advantage of this, making sure you have the company paying your state taxes on your behalf. In California, they have specific rules on when you have to do that, so that's something you want to definitely talk to your tax person about to make sure you can take advantage of that.
And this is one reason to have a legal entity. We'll talk about legal entities in just a moment, but this is an example of why you would consider earning commissions in a legal entity because then you can take advantage of this. I mean, effectively, it's, if you used to pay $80,000 of state income taxes personally, we can't write it off. But if you had the business pay for it, it becomes a business deduction. And again, super important for California folks because we pay so much California
Oh yeah,
taxes.
think about what we were talking about earlier, right? Let's say you have $80,000 of state income taxes, you have $20,000 of property taxes. Well, before now that's $100,000. You're only going to deduct 40. But if you have the company pay the 80 and you pay the $20,000 of property taxes, now we can deduct the whole $100,000. So it's a huge benefit to making sure you can, take advantage of the full allowable deductions.
Yeah, and if you're, $100,000 write-off, if you're at 37% federal tax bracket, that's 37,000 of cash, right, that you just saved, rather than just overpaying the government. This, unfortunately, is also another area we see missed all the time. So how do you know if you're utilizing it? I mean, ask your CPA, right? Am I using the pass-through entity tax break? Another way you know is how are you paying your estimated taxes, right? How are you paying your quarterlies? Are you paying it from your personal account, or is the business paying it? That's another sign that you know whether you're utilizing this correctly.
Yeah, and then just touching on rental real estate, I mean, one of the big things that got passed with the one big beautiful bill is bringing back 100% bonus depreciation. So for all those rental property investors, certain assets in your rental properties, 5, 7, 15-year assets, those are eligible for bonus depreciation. But back in 2022, we had 100% and it was cutting down 20% every year. So we were going to have 40% this year. But now that they brought back 100% bonus depreciation, we're basically, where we think as a firm, we're going to see a lot of our clients being aggressively buying more rental properties between now and year end to kind of get more depreciation expense and take advantage of that. We've got clients that bought rental properties earlier in the year. They were getting, cost segregation proposals. The benefit of those cost segregation proposals are essentially doubling because of the change in the law now. And so it's going to be, I think, a huge benefit for rental property investors. The caveat here is that you had to have bought and placed the property in service after January 19th, 2025. So if you can meet, you bought one in February, put it in service, it can qualify for bonus depreciation. The certain assets in the building can qualify. If you happen to buy before January 19th,
40%.
you're going to get 40% bonus depreciation under the old law. So
Basically, when we run numbers for clients, the tax savings doubled, right? More than doubled for real estate investors because we're going from 40 to 60, 40% to 100%. And then just kind of a quick note, bonus depreciation is not only for rental real estate, it is for business owners as well. So if you're buying, assets that you're using in your realtor business, 100% bonus depreciation, Section 179, those are all still available. And effectively, it's just allowing us to write off more faster rather than having to depreciate things over time, right? So make sure we capture that.
I'll save my questions on that till later, but this includes automobiles, like
Yep.
business assets, equipment, things like that, right?
Yep,
yep,
exactly.
exactly.
Yep, car is a big one for bonus, and then also Section 179. So as you can see, there are a lot of really good new tax benefits that are available. We didn't talk about all the individual ones because we want to kind of focus more on real estate and realtors. But one of the things to understand is that these tax benefits are not automatic, right? It's not like, oh, the law passed, I will naturally expect to pay less taxes. We really need to make sure we are being proactive to plan during the year. So I know, Abe, earlier you said that the key word here today is strategy. And that unfortunately is one of the biggest mistakes that we see, whether from realtors or investors or just people who are working W-2 job, is not being proactive and assuming that their CPA, their tax person, is doing what they can to help you save on taxes. When you meet with your CPA in April, all they're doing is reporting what did or didn't happen last year, right? The time to plan to really save on taxes is actually during the year before you earn that income. Should I earn it individually or in an S corp? Before I buy a rental property, should I buy it in my LLC or in my personal name or a trust, right? So we want to make sure that we are being proactive during the year. And that's super important because time after time or year after year, research shows that the biggest silent wealth killer is actually taxes. And in fact, we spend more money in taxes than we do on food, clothing, and housing combined. And if you're in the business of real estate, that's what you're saying. This is a big talking point for your clients. In fact, somebody making $500,000, they get about 190,000 or 199 left after they pay federal, California, payroll, all the various taxes. So we always have clients who are like, hey, I make so much money, but I have no money for real estate. Well, guess what? Let's save some money in taxes, and then you can use the taxes saved to buy more real estate, right? Instead of just, losing all of it.
Yeah, so I think it's eye-opening to us still every day around when we think about that people are spending more money on food, clothing, and shelter than they are, or spending more money in taxes and food, clothing, and shelter, which are other biggest expenses, right? So um it's very important that, I think to be proactive, change the way kind of we're thinking, how we're approaching things, and because I think it'll be essential for a good strategy for sure.
So I know earlier we shared that we wrote two books. We have a pop quiz here, and I don't know if people can put anything in the chat box or Q&A box, but if so, we have a little pop quiz. Okay. Oh, before I share the question. So the first person who gets it right, and I don't know if you guys want to just shout it out. If you get it right, we'll send you a copy of our book. If you're in Abe's office, we'll walk it over to you because you're right there.
Mm.
All right. So whenever we do tax planning, when we meet with new clients, the first thing we do is review a previous year's tax return, right? Because that tells us a lot. I mean, it tells us about what they've done, what they own, and all those great things. So the question is for the pop quiz, what percentage of tax returns we review do you think are not optimized for tax savings?
So our options are 5, 15, 20, and 40%.
Guys, if
Okay,
you
I
want
don't
to
know.
answer this question, put it into Slack. Put it into our Slack right now. I'm watching it. Put it into the general in Slack, and we'll
Now
be.
to win, you do have to choose one of the options on the screen. You can't choose 50 or 80% or something like that. But
John said 40%. Andrew said 50, which Andrew is not even one of the available options, but awesome, awesome. Okay, well, while you guys figure out who won, I think AB can tell us later. The correct answer is 40%. Now, this is not any like national research. This is just for us internally. We look at tax returns day in and day out with new clients, and about 40% of tax returns are not optimized. And so we're gonna spend a couple minutes to share with you guys what are some of the common mistakes we see with of client profiles like you guys and your clients, because I think that will kind of give you an idea to see like whether you might be a victim to some of these mistakes.
victim.
Victim. So the first one is missed tax deductions. I think people are always wondering, like, what can I write off, right? And for investors specifically, and even realtors, generally we're pretty good about writing off direct expenses to real estate, right? Like, oh, I have marketing expense, or I have mortgage interest, property taxes, property management fees. Everybody's pretty good about writing off those kinds of things because it's directly related to real estate. But what's missed all the time are what we consider overhead expenses. Overhead expenses are things that are maybe not so closely directed to the activity itself. So home office, a big one, right? Personal use or business use of a personal vehicle. Um,
Maybe you're going to conferences, right? You're going, dues,
business meals with colleagues, right?
yeah.
Professional development stuff, like, is this really business related? So when you have a lot of these expenses, a good thing to do is to ask yourself, right? Is this something that I think is ordinary and necessary to me as a realtor?
Or
Uh,
me as an
as
investor.
an investor? And if the answer is yes, then you track those expenses. And this is really important because you are the first line of defense when it comes to maximizing taxes because your CPA is not with you day in and day out. And so if you are already determining something is not deductible, your CPA generally will never even see it. Right. And so that just becomes something that's lost. And for realtors specifically, there's so many things you do from a day-to-day perspective that are tax deductible. We have like, a realtor who's like, hey, every time I close on a property, I'm gonna, have my client host their friends. I'm gonna pay for a dinner or pay for kind of a housewarming. And those expenses are tax deductible because they're business related. It's for you to generate more business. If your CPA is telling you not to take a home office expense because it's a red audit flag, another sign you need a new CPA because that has not been the case for over 20 years. In fact, the IRS has made it easier for us to claim these deductions. Same for business business use of cars. If your car is in your personal name, you can still write it off. It does not have to be in your LLC specifically. Okay.
Yeah, a good tip for auto stuff is utilize one of those mile tracking apps. Like Mile IQ is one a lot of our clients use. You want to be able to figure out what the business use percentage of the vehicle is going to be at the end of the year. So that's important. Get some work done on the vehicle at the beginning or end of the year, so you have a third party documentation of what the starting mileage was. That's a good way to prove that, hey, what my odometer said on January 1st or whatnot. So
Yeah.
that's a good way to kind of keep track of the mileage or help you do that.
Yeah. So for our clients, we have a 100 plus tax deductions checklist that they can refer to some of these commonly missed items specifically for real estate, right? So these are the kinds of things that are helpful. So for you to get an understanding, like what can I actually write off? Um, the other thing that we see missed quite a bit is wrong legal entities. If you're a realtor, I would say if real estate is kind of your full-time thing, and if you're making, over $40,000 for the year, generally you should be operating in a legal entity, right? So generally going to be S corporation, and the reason for the S corp is that it helps you to save up to 15% in self-employment taxes. So from a high-level perspective, if you're someone making $100,000 of net profit, an S corp versus LLC, the S corp will probably save you about $7,000 in self-employment taxes or more. And so the higher your income, the more potential tax savings by operating inside of an S corporation.
And this is true whether you were operating your personal name or when she says an LLC or just running it through an LLC that's a disregarded entity. Either one of those situations is being reported on a Schedule C in your 1040, right? So the workaround here is, yeah, if we're making, $40,000, $50,000 more of profit in the business in California, it probably makes sense to look at utilizing an S corporation so we can minimize those payroll/self-employment taxes.
A lot of people tend to think like I have an entity to write off more things, and that's actually not true. We could write off the same things regardless of whether you're earning your income individually or through an entity. The actual benefit of the entity is that we get to pay less taxes because of tax rate differences and how entities are taxed. And then also one of the things we said earlier, if you have a legal entity like a S corp, now the entity could pay for your personal state income taxes, and that becomes a write-off, right?
And then on the investor side of things, from a legal entity perspective, there's a lot of, I think, misunderstanding out there too. So typically from our perspective, you talk to lawyers, generally the LLC is going to make the most sense for holding title to rental properties. But what we want to try to avoid is having entities that are taxed as S corps or C corps holding title to rental properties. We don't want to have S corps or C corps owning long-term appreciating assets. There can be tax consequences down the road. There can be, if you're trying to retitle the property for a loan, or if you're just trying to take losses from the property, there can be issues with that from a tax perspective. So, for your rental properties or for your clients' rental properties, just so you know, generally the LLC is going to make the most sense, but it's going to be an LLC that's either a disregarded entity or it's one that's, if it's owned by spouses, it can be filed as a partnership as well. But we just don't want to have S corps or C corps own rental properties. It's kind of the big picture takeaway on that.
This can totally be a hero if you have a client who's coming to buy a rental property and they're like closing in the corporation's name. You can say, hey, please double check with your CPA, because my understanding is we almost never want to hold title to real estate inside of corporations, unless if they're flipping, right? But for rentals,
For rentals, yeah.
investments and things like that, generally it's going to be some sort of an LLC.
We have a colleague that has a T-shirt. She made her own T-shirt that says, "What does it say?
No rentals in
No
corporations.
rentals and S corps or something like that." So
Yeah,
it's a big enough tidbit that she made her own T-shirt out of it. So
yeah. So for those of you who own rental real estate also, right, you probably need to have two entities. You have your S corp where you're earning all of your commissions income and running your business through, and you'll have a separate LLC that is for rental real estate. I know especially for California folks, it's like people always tell us like, I don't want to pay too many of the $800 franchise fees. I just put it all together. Don't do that. Okay. All right, depreciation, obviously a big one. Again, whether it's for your realtor business, you're claiming depreciation on your vehicle, or for rental, real estate investors claiming depreciation on the property itself. It's a mistake area we see pretty frequently. What we love about depreciation is that it's so flexible, right? You can take the standard, if we're talking residential real estate, I think, which is most of us here, residential rentals, we depreciated over 27 and a half years. But if you're someone who has a lot of other income that you could offset, let's say I made $1 million with commissions, I have rentals, I want to offset my commissions income, we can do accelerated depreciation. So we can depreciate things much faster through cost segregation. And like Matt said earlier, now with 100% bonus depreciation, I mean, on a $1 million property, let's say it's 1.2 million purchase price. Maybe we can depreciate up to 300,000 in the first year. So very, very significant. We're gonna go over an example in just a moment using
I think
actual property.
and one of the mistakes we see is like, Amanda has mentioned, we kind of, when clients come to us initially, we're looking at prior tax returns. One of the things we see is that they're not taking full advantage of depreciation. As she said, you can slow it down, you can speed it up. There's times to spread it out. But I think unfortunately what we see a lot is, I think the default for most people is to spread out depreciation. But if you're going to be in the same tax bracket this year versus the next 4 years, why would you not want to take it all up front right now? Reduce your taxes now, save the taxes now, use that money to reinvest and continue to grow your wealth versus spreading out that savings over 5 or 7 years or whatnot. So I think that's a default that we see, unfortunately, a lot that doesn't help taxpayers, unfortunately.
All right. The last topic we wanted to talk about for this morning is retirement investing strategies. And so the question that for you to consider is, would I rather pay the IRS or would I rather pay towards my own retirement account? Right. And here we're talking about can we redirect money that was otherwise going to taxes into my own retirement, whether it's IRA, 401k, a pension plan? And for all of you who are realtors, this is such an amazing opportunity because if you don't have W-2 employees of your own, you could literally fund just for yourself, up to even up to
$70,000.
70,000 or even over $200,000 into your own retirement to save on taxes, right? And so if I'm saying, okay, well, I have $70,000 or 50 or 40, I would rather put it into retirement like a 401k of my own versus paying it to the IRS. And what's really amazing about that is once you put it into the retirement account, it grows tax deferred. And for those of you who might not be familiar, there's a concept called self-directed investing. And so I could put it in my 401k, I can self-direct it to invest in rental real estate, or I can lend it to Abe if he was doing some real estate deals. So it's a really great opportunity. What we always say is like, okay, if you put it in retirement account, you invest in, what's your return on investment? I mean, minimum, like, I don't know, 2%, right? But if you pay it to the IRS in taxes, what's your return on investment? It's zero, okay? Because it's
Not a trick question.
it's not coming back. And what's really amazing too is they changed the law a couple years ago where for those of you who didn't file 2024 tax returns yet, you potentially could still fund today to reduce last year's taxes. So we still have that opportunity. So if you're like meeting with your CPA in the next couple of weeks or months and they're like, hey, this is your tax bill, talk to them about, hey,
Hey, I don't like that. I don't like that tax bill.
Yeah, can I redirect some of this to my retirement instead of paying the government?
Amanda, Matt, is this SEP IRA? Is that the concept? Or
SEP
is it
IRA is one of those vehicles. We don't like the SEP IRA as much just because it's not as flexible and you can't put in as much as you could with like a 401k plan. So for our clients who are, realtors, brokers, we're typically looking more into like 401k, individual 401k / defined benefit plans. So those are typically, it's similar to the SEP, but it's more powerful.
That's awesome.
Yes. All right, so we're gonna share real quick kind of like I said, a tax strategy stacking. We went over a couple different things, right? But just so to put sort of some numbers to it to see how it plays out on an actual client case. In this case, we're sharing is Mike and Trisha. You can change the name to be yourself, right? Because it's a very similar profile, probably with a lot of you. So, let me go back a little bit. So Mike is an engineer, Trisha is a realtor. California typically pay a ton in taxes. So these are some of the concepts that we helped them with when it comes
And helping
to
them with throughout the year, right? We're kind of, what's the projections going to be for this coming 2025 tax year?
yeah, to build wealth and to save on taxes. And I always tell our clients who are realtors, like, you have to invest in real estate. You are in the business of real estate already. You have to be an investor because the tax savings are just so significant that it's sort of like a low-hanging fruit, right? So for Mike and Trisha, about 600,000 of W-2 and realtor income combined. And we're combining like all the W-2 and S corp, everything, just to keep things simple. They bought one rental property. No, they bought two rentals. I think the total was about $1.1 million. One was in California, the other one was in Vegas. Now, conservatively, first year expected net rental income after operational expenses and interest, about 29,000, so just under 30,000. Okay. So, we talked about maximizing expenses, right? Retirement contributions. So for them, set up a solo 401k for Trisha so that she could fund retirement rather than to pay the IRS. Earlier we said the maximum about 70,000, but for them, they didn't want to do the max. They want to keep some of the cash back for unexpected things for their rental property. So this is what they plan to fund their retirement accounts.
And also, we kind of talked about, maximizing some of those other expenses that we mentioned earlier that overlooked a lot, right? Car expenses, travel expenses, income shifting, basically paying their kids to help them in their business. So for them, kind of we're projecting around $16,000 of a write-off there.
Yeah, nothing crazy. Didn't buy a brand new car. It was just the existing car they had. Now they're just going to make sure they write it off. But the big one is on the rental real estate, right? So not only do they get about 29,000 of rental income, this is the first year depreciation write-off they are expecting using 100% bonus, purchase price 1.1 million across the two properties. So you can see how with almost 650,000 of income that we started with between W-2, realtor, and rentals, now their taxable amount is 324,000. Okay, so that's over 100,000 savings just with, maximizing retirement, making sure they track expenses, and doing accelerated depreciation on their rental property.
Now you can see here that they're going to be able to take advantage of this because Trisha's going to be able to qualify as a real estate professional for tax purposes. Now you guys may have heard that term thrown around, maybe misunderstood kind of how it works, but it has nothing to do with you guys being licensed, but that can help you in this situation actually. So for her, they're going to self-manage these two properties. And with her hours being a realtor and her hours self-managing the property, she's going to easily be able to qualify as a real estate professional, which will allow them to take advantage of writing off this depreciation benefit and some of these other things in the immediate year. And that's where they're going to be able to bring their income down from, 650, 660,000 all the way down to $325,000. So it's going to be a huge benefit for them. Again, you guys are already realtors. You should be investing in rental real estate. It would, encourage you highly to look into doing that if you're not already doing it for sure.
And if you think about it, $100,000 in taxes saved, that's a down payment on another $500,000 worth of rental property, right? So what a lot of our clients do is this strategy, but rinse and repeat. So every year, continue to do it. I know earlier, Abe, you were talking about, hey, when we talk to clients, it's like they're not going to sell their house. They have a 3% mortgage or interest rate. What do we do? Well, how about we tap into the equity? Right. So if I have a primary home, I want to keep my interest rate, but can I still tap into it somehow? Do I have a big stock portfolio that I can leverage, right? Borrow against my stocks and use that to invest in real estate. So these are the types of like fund strategies we work with clients on to say, we're not just looking at cash to invest in real estate. What are the other assets? So we call them lazy assets, right? A paid off home or just something that's not doing anything. How do we leverage those to then build wealth and also save on taxes at the same time?
And then the other thing, worth mentioning, right, is we call it strategy stacking because if you look at this situation without kind of being a real estate professional, their income is going to be over $600,000, right? So they're gonna get that haircut on the state and local taxes, right? So they're gonna instead of being able to deduct 40,000, they can only deduct 10.
No child taxes
No
are
child
paid.
tax credits. But now that we brought their income all the way under $350,000, they're going to be able to take full advantage of the state and local tax. They're going to be able to take advantage of child tax credits and probably some other ancillary benefits they're going to come into play too. So it's not just hey, depreciation, help me. When we start bringing you're managing your tax brackets and bringing those down, opens up a lot of other opportunities they may not, you may not typically be able to benefit from.
I think this is amazing. Actually, there's a quick clarifying question here because I do see this on Instagram quite a bit, right? Become a real estate professional. You don't need your license, just need to buy rental property. Are you able to cut into W-2 income here? Uh,
Yeah, it depends.
depend.
So if in this example, right, for Mike is W-2, Trisha is a real estate professional. It's what we call the marriage loophole. So if you can't be a real estate professional because you're working full time, but your spouse is, then yes, you can cut into both, right, the income combined for both spouses. So yeah, a joke we always say is if you're not a real estate professional, then marry one, right? Let's put that on your dating app,
That's our tax advice.
your dating profile.
There you go.
I'm a vegetarian and real estate professional.
Yes.
Um, but for people who are W-2, let's say you have two spouses, both W-2 income, right? They're working full time. One thing to consider is the short-term rental tax loophole. So I don't know if you guys help investors with short-term rental stuff, but if you do, that one works really well for essentially anyone. So we have clients who are teachers, who are attorneys, doctors, social media influencers, celebrities, athletes. They all use that because you don't have to be a real estate professional. You could potentially use short-term rental losses against W-2. And just a quick definition, short-term rental is a property where the average guest stay is 7 days or less. So, the traditional kind of Airbnb structure, that's what's defined as short-term rentals.
I see this one too. There's like sometimes sizzle lines that say something like retire your spouse, you can make more money
Yes.
doing that.
Oh,
Is that
yes.
what it
I
does?
just did one.
Yeah.
Yes. So
Is
here's,
that your sizzle
yeah, no,
line?
I mean, I don't know, but I just was interviewed on a podcast where I shared. So this is another common scenario we see, guys, is you have let's say, for example, Mike made $600,000, right? And Trisha made 30,000. Okay, that was the profile. And they were both working W-2. Well, if they stopped working, if Trisha stopped working and became a real estate professional, you can see, right? We gave up 30,000 of W-2, but we're saving $100,000 in taxes. So the net impact is I end up ahead by having my spouse not work, give up that smaller W-2 in exchange for the massive tax savings.
Mm.
Because the alternative is that they were both working W-2 and she was not a realtor, she was not a real estate professional, then my rental losses are passive and I'm not able to use it against W-2 income.
Great. One other small question,
Um,
we'll probably get into this
yes.
more, is on depreciation. You mentioned cost segregation study. Could you break it down
Yes.
for us a little bit? I've even seen cost segregation like engineer as the person that does
Yeah.
the study for you. Could you
Right.
give us an idea of what that entails and what that accomplishes?
Yeah, for sure. So for rental properties, I think taking a step back, as Amanda mentioned earlier, typical rental properties, residential properties, we depreciate those buildings over 27 and a half years, right? Non-residential, we depreciate them over 39 years. So what a cost segregation study is doing is they are done by engineering companies that are specialized in this type of work. But what they're doing is they're coming in and looking at the building and saying, hey, there's things inside here that um, can qualify as 5-year property, 7-year property, 15-year property, thereby being depreciated much faster. Um, and then when you throw bonus depreciation on top of it, so now that the cost seg is going to allocate the stuff from 27-year building to 5, 7, and 15-year property. Then you throw the benefits of bonus depreciation on top of it. That's where it really can supercharge the benefits of a cost seg study. So really, they're coming in and looking at the building and breaking down the different components so that we can depreciate it faster. Over the life of the asset, we're going to get the same amount of depreciation. But the idea being is that if we can benefit from it, let's try and accelerate the depreciation to now so we can utilize it now, save taxes now, use that savings to be a down payment on another $500,000 property.
Matt, Amanda, what happens if you sell the property and you depreciate it and took acceleration on depreciation?
If you sell the property, then you have what's called depreciation recapture, and that simply means you already wrote off this $100,000. You're not going to write it off again, right? So to the extent I have gain, I'm going to pay taxes on that gain because I already wrote off part of it. For most of our clients who do real estate investing, they're not looking to cash out and put their money in the stock market. For most of them, if they were to sell this property, they're probably going to trade up, do a 1031 exchange into, bigger, better properties. And so if you do things correctly in a 1031 exchange, then generally you don't have to worry as much about depreciation recapture. And I know there are a lot of CPAs who really kind of make recapture sound like this big scary thing, when in reality there are so many different ways that you can offset it. And that kind of brings up, brings us to our next slide. The question here is, does your accountant talk to you more about what you can't do versus what you can do? Are you told a lot of these scare tactics like IRS audits, don't claim this, you'll be audited. Don't do a cost segregation, it's too expensive, right? Don't do depreciation because of depreciation recapture. These are all signs that you're not working with someone who's very strategic. Because like I said, yes, there is recapture, but the question becomes, how do we offset the recapture? How do we avoid that with a 1031 exchange? Do we invest in more real estate? Do we look at other ways to create some capital losses from our stock portfolio? So there's always ways to offset some of the strategies. It's just how you look at it, right? And so um, if you're someone who's wondering like, gosh, I wonder if I'm overpaying in taxes or not, unfortunately, we can't answer that question for each of you on this forum. But what we did is create a self-assessment. So it's our 360 tax risk assessment. You can scan the QR code or take a screenshot of it. It basically takes you to a self-assessment that we put together, and it's composed of I don't know, maybe 20 or 30 questions, encompassing personal, real estate, investment, business, and retirement. And at the end of it, you'll get a score. If you score high, great. It means you're doing a lot of the foundational things to protect your hard earned money. If you score really low, that's also okay because what you can do is print it out and use it as a roadmap. So that next time when you meet with your CPA, you can say, hey, I took a little quiz here and here are all the things I said no to. Let's start the conversation there, right? In terms of identifying opportunities. And I always tell people, it is upon you to call your CPA because if you're like most people, you're lucky if your CPA picks up the phone when you call them. You're lucky if they respond to your email. So you have to be proactive in contacting them and ensuring you get a strategy meeting, a planning meeting, right? Because they're not thinking about you all the time. And the reality is, no one cares about your money more than you. So take the time to learn how to protect your money. And what you learn also helps your clients too, right? Because you're helping them invest and protect their hard-earned money. So you're not going to be CPAs, but whatever that can share, that's just another value add for what you guys are doing. So all right. Questions. I see there's like a lot of questions in here.
Yeah, there's a lot. Maybe I could start off with some of the ones. So going back to, let's say, like the structure or the entity holding a property. Um, I know that there are pass-through entities like LLCs, depending on who is involved, or even corporations. Could you talk about like maybe like audit risk a little bit? Are there entity structures, S corp, C corp, LLC, pass-through entity, partnerships
Mhm,
that have a little bit more like I don't know, safety in terms
mhm.
of audit risk?
Yeah, I mean, Iris doesn't really share definitively this information, but what we've experienced is sole proprietors are probably the most likely audited. And I think from their perspective, sole proprietors kind of give off the feel of someone who's not really operating a business full time or legitimately. So easier, right? Maybe they're not tracking receipts. So if you're someone with higher commissions, typically, legal entity is lower risk. From an audit perspective. So S corporations, partnerships, those are generally going to be lower than a one person LLC or a sole proprietor.
And then on the rental real estate side of things, you could certainly own rental real estate in your personal name. It would go on your personal tax return or your Schedule E, right? If you're going to be a real estate professional, claim deductions, there's nothing wrong with that. Now the question would be, how's that, is there less audit risk doing the same thing in some sort of legal entity? So you could own your real estate in an LLC, and in California, if you have husband and wife or spouses, you can either file as a disregarded entity just like that, keep it on Schedule E, or you can choose to file as a partnership. Now, again, the IRS doesn't come out and say this, but from talking to colleagues and our own personal opinion is that if you do own rental real estate in LLC and you file as a partnership and do the same thing, your cost seg, you're going to take the real estate professional benefit on your personal return. We feel like there's less audit risk doing it through the partnership return than doing it straight on your personal return. Now, some people don't have that option. They're not married. They own the LLC just themselves. It's going to go on their Schedule E. But California with community property, you might have that option anyway. So that would be something worth looking at for sure to minimize risk.
It's cool. In that like vein of question, we do have sole proprietors, right? All of our agents are 1099 folks, and they're set up in an entity, or some of them are not. Um, are there maybe some tips you could share to be a little bit more audit proof? You mentioned the mileage tracking app. I think that's a great one, but more things like that. Should they be holding receipts and labeling them? Yeah.
Yes, people don't like the answer though. The answer is yes, you should keep receipts. But you don't have to keep those thin little paper copies. You know what I do is I just take a picture. If it's business related, I pay with my business card. I take a picture of the receipt. I don't really like organize it specifically. For me, it's kind of all goes into one folder on my phone. And so if you're ever audited, you have a way to pull it up, right? So that's pretty simple and straightforward. For those of you who are in sole proprietorships, what I highly recommend is that you still have a separate bank account. It would be your personal name because you don't have an entity, but a separate bank account that you use exclusively for real estate. That's going to make life so much easier because if you're just running all your business stuff through your personal bank account, then you have to sift through and figure out what's business, what's personal. So for those of, yeah, I mean, if you have a legal entity, obviously you'll have a bank account for the entity that makes everything clean. But if you don't, at least still a separate personal account. There are times when the IRS will only audit part of your return. So they might say, I'm only auditing your Schedule C sole proprietorship. And so one way to protect yourself is to have a separate bank account, right? Because if you had to show bank information and it's all commingled with your personal, now they're like, well, since I'm here, let me take a look at this other stuff, right? Like your aunt gave you $10,000, they're going to trace it and say, what is this all about? Should you pay taxes on it?
Same thing with rental properties. Generally recommended to have separate bank account for the rental property. Now you can have one account for multiple rental properties. Might make your own bookkeeping and tracking a little bit harder. Some people like to have separate accounts for each property. That's going to be a personal preference, but definitely want to have a separate bank account compared to your personal account, right? For that exact same reason. And then from a financial statement perspective, a lot of times as people are starting to get into it, rental properties business, Excel templates can work fine. Um, but you're going to probably graduate to something better than that, like QuickBooks or some of those full blown kind of softwares that will give you balance sheets, P&L. But using something like that versus writing it down on paper, obviously, is going to look a lot better. You're going to be more organized if you did get audited for that matter.
Mm. Is it sufficient just to have like a separate account and a separate credit card for, let's say, your business expenses? Or do you really, like you're saying, take photos, said business purposes somewhere logged? What would you recommend there?
Yeah. I always recommend taking photos of the actual receipts because if you're audited, that's what they ask for. So the credit card statement shows proof of payment, but the receipt shows what was the payment for. So if I have a charge on, I have a Costco charge of $500, that proves I had an expense, but it doesn't prove what did I buy, right? So I could have
Yeah,
bought
so then I have the
diapers.
question is why is she spending $500 at Costco, right?
When you go to Costco.
Yes.
That is the minimum.
Yeah, exactly.
Um, but so they don't know if I bought diapers and milk for the kids, right? So the receipt will be able to show them, oh, it was like stamps and paper, or I bought a laptop or whatnot. So that's the purpose of the receipts. And I always tell people the IRS is not scary. I know a lot of CPAs tend to make it super scary, like don't do this, don't write this off. The IRS, they're like a SWAT team, but they're actually not. They're just regular folks doing their job, right? They go to a job um, and so if you're being proactive, like documenting your stuff, doing the right things, buying the right properties, holding title the right way, then they're generally pretty good, right? It's kind of like if you think of it from the perspective of school, where when you go to school, you want to show the teacher you're an A+ student, you come organized, you are nice, you are polite, then they're nice back, right? But if you come to school like a jerk and you don't have paper or pencil, then they're like, yeah, this guy's, I don't really trust what he says.
Right.
So same thing for on audits.
That's great. Kind of switching gears, we have at Circa some agents that are starting to now flip homes or get involved in that. Um, I know that, we know that flipping a home is a very different activity than holding an asset long term. Do you have any tips on maybe how agents could set up or best optimize kind of tax savings for people who are looking
Yeah.
to?
So fix and flip is active income, just like realtor commissions. So from an entity structuring perspective, generally our recommendation is you either flip in the same entity where your commission's being earned, or you do that in a baby entity. So, for example, I have a flip LLC, and that LLC could be owned 100% by my realtor LLC, or vice versa. And the reason for that is because they're both active income. If I have a corporation, right, my S corp, then I only have
LLC, she said LB. LLC is gonna be taxed as an S corp in this example.
yes, and so I would only have to do one payroll, right? One 401k account. I can consolidate all those versus if I had an S corp for my commissions, an S corp for my flip, now I got to have two payrolls, two 401ks, kind of doubles up on all, two tax returns. So that's really the only main thing. I think it's important to keep in mind, just so we all know, when we talk about the tax benefits of real estate, we're talking rental real estate, depreciation, cost segregation. Those are not available for a fix and flip because at the end of the day, I'm selling the flip, right? I'm selling the property, so I don't get to take depreciation on that property. So a better way to do it is what we call flip to hold. So basically the BRRRR method, for those of you who are familiar with bigger pockets, right? Buy, rehab, but rent it out, and then you can sell it in a year or two in 1031 exchange and kind of repeat the same process. I mean, the difference could be over 50% taxes in flipping versus no tax if you keep it as a rental and we take depreciation. So pretty significant.
That's right. Yeah, we have several flippers kind of in our agent body, and the biggest regret that a lot of them have is selling the property or
Of
flipping
course.
too quick, right? If I just kept that for like 4 years or 5 years, there'd been like ton of appreciation, all that. So yeah, we do preach that here as well. Like, to that point, like we have a question here too, where it's if you own property in multiple states, right, multiple properties I'm sorry, like liability aside, like from a tax standpoint, for accounting standpoint, is there a better setup? Should each of them be in individual LLCs?
Yeah, I mean, I think you kind of hit the nail on the head that a lot of that conversation is going to be driven from the asset protection angle and the attorney's recommendation. Like, do we need to have separate LLCs to kind of segregate risk? But purely from a tax and accounting perspective, there's nothing wrong with having one LLC own properties in multiple states. You're going to probably need to file state tax returns in each of those states, depending on the state, but that would be the case whether you have separate LLCs or not. So it can make things easier to kind of have everything roll up into one LLC. If that LLC is filing like a partnership return, less partnership returns to file, obviously, so that can save you from that perspective. But I think I would start the conversation with the attorney because that's going to be important in terms of, hey, no, we don't want to combine that property with this one because of A, B, or C reason. That might over preside over the accounting simplifications of having one entity for that matter.
In California, every entity has
That
$800,
that
right?
too, yeah.
So the fewer entities we have, the better it is. It's always sort of a cost benefit analysis. I see a question here from Jenna about, can you talk a bit about using IRA money for real estate? So uh, that's probably like an 8-hour topic. I have one of our friends actually, one of our clients owns a self-directed IRA company. If you guys think it's helpful, I'll connect you, Abe, with her and she can come and do the whole thing. It's pretty phenomenal if you advise clients on kind of how to use that to acquire real estate.
Yeah,
But we have to hop off. We had an 11 o'clock meeting we're a
oh, no,
couple minutes late for.
got it. What we'll do is thank you again so much for your time, Matt and Amanda. We're probably gonna have a lot of people that want to connect with you. So if you don't mind, maybe we can just like for you or your associates, like maybe just email introduce them, and then take it from there. And again, thank you so much for your time. This is invaluable.
Yes.
Hopefully do it again at some point. And if we can do anything for you, please don't hesitate to ask. All right.
Yeah, for sure. If you're looking for daily, so our company is called Keystone CPA. So you can go to keystonecpa.com. A lot of great free information on there, and tax updates. If you're looking for daily tax tips, like Abe said before, best place to find me is on Instagram as Amanda Han CPA, and our YouTube channel is the same handle as well. So wonderful to meet everyone.
Thanks, everybody. Thanks, Abe.
Thank you so much, guys. We'll talk again soon.
Bye,
Bye,
All
guys.
guys.
right. Bye now.